You may think that sharing one's 2024 stock market results as late as in March the following year is a bit slow. Some would even call it sloppy. Since I haven't shared my results from 2023 yet, I call it improvement. In all seriousness, sorry for this delay. But in this video, I'll share with you my stock market success, or lack thereof, from 2024. And I'll finish the video by also updating you on my US stock portfolio for 2025, which is an update of the 2024 version, which had a 38% return during the year. Alright, the Patreon portfolio, which is a mirror image of my own portfolio, where I invest 95% of all my money, had a return of 14.9% during 2024. That's pre-tax but after transaction costs. In a vacuum, I'm quite happy with these results. My return since I started investing approximately 11.5 years ago in August 2013 have been 17.8% per year. So, it's a little bit worse than my historical average, but not too bad. However, the stock market is a game of opportunity costs. And during 2024, there were some truly mouth-watering alternatives out there. For instance, I could have put my money in SPY, an S&P 500 ETF, tracking the development of 500 of the largest companies in America, and gained a whopping 25.3% instead. It's certainly been easy to degenerate into one of the worst of these 7 deadly sins, envy. But then I remembered some words of wisdom from Warren Buffett.
If you paid somebody $2 million, they might be quite happy until they found out the guy next to them made $2.1 million, and then they were miserable. All you get out of envy is this miserable grinding in your stomach and all that sort of thing. Compare that to some of the other sins like gluttony, which we are about to engage in. There's some upside to gluttony. I'm told there's upside to lust, but I'll leave that to Charlie to explain.
Of course, investing in the S&P 500 could also have saved me a lot of time, as I've devoted somewhere in the range of 1,000 to 1,500 hours to the Patreon portfolio during the year. So, am I unhappy about the results? Well, I'm not thrilled. I have higher expectations, but I'm not totally disappointed either, and I'll give you 2 arguments for why. First, the US has been incredibly strong, while the rest of the world really hasn't. 25.3% is of course incredible, but such returns haven't been seen in many other places outside the US and the Magnificent Seven. For instance, the UK was up just 9.5%. Poor France was up just 0.6%, and Sweden managed 8.6%. Just to mention a few. If you were anywhere but in the US during 2024, it was quite tough, or, well, at least not as pleasant as 25.3%. Since I'm a global investor with quite a lot of equity in the Nordic countries and Europe as well as in the US, I didn't really benefit as much as a pure American investor did during 2024. However, on the 30th of December 2023, I made a 10-hour video where I picked a portfolio for 2024 in a single session. Here, I decided on picking a 100% US-based portfolio because I felt that people would be more familiar with the companies and it would also allow me for a more consistent analytical approach. Mixing American and Polish companies, for example, brings some extra complexity to the valuation process. I invested $3,000 and spread it evenly across 10 companies. How did this American portfolio do? It was up 38.6% during the year. To be fair, that includes a positive currency exchange effect of almost 10%, but still, this portfolio beat the S&P 500. By the way, stay tuned until the end of the video to see the 2025 American portfolio. My second reason for not being too upset about underperforming the S&P 500 during the year is that small caps underperformed large caps. During 2024, large cap stocks outperformed small caps by quite a substantial margin. The MSCI is probably the most commonly used global equity benchmark, and here the difference is striking, 19.2% versus 8.7% in favor of the large caps. The Magnificent Seven have been a big contributor, as they make up about 23% of the whole large cap world index today. Being a smaller investor comes with the advantage of having more opportunities. My stock market portfolio is still small enough for me to enter companies with, for instance, 50 million in market capitalization without me affecting the price of the stock, and with the position being large enough to be meaningful for my overall returns. According to many of the greatest investors, you are even supposed to be in smaller stocks, because the chances of them being mispriced is higher.
If I were working with small sums of money, it would just open up thousands of possibilities to me. And it would be bonds, it would be stocks, both in the United States and elsewhere. Most of them will be in small stocks. If you're working with small money, they'll be in small stocks or in some specialized bond situations. Wouldn't you say that, Charlie?
Sure.
But during a year like 2024, you'd have a structural disadvantage of a little more than 10% applying this. So, last year, my strategy of being in smaller companies didn't pay, but I hope that, over time, it should. Of course, comparing one's track record on a 12-month basis is fraught with difficulties. Even someone like Warren Buffett has underperformed during many years in his Berkshire Hathaway. Heck, there's even a 5-year period where Berkshire underperformed the S&P while it was still fairly small. So, one clearly shouldn't expect to beat one's benchmark every year. But still, I think we can make the comparison a bit fairer by creating a better benchmark index, by neutralizing the US and the large cap biases that existed during 2024. So I used this screener on Ticker to filter out about 7,500 companies that I could potentially have owned during the year. I then hired a blindfolded dot-throwing monkey to pick out portfolios for me. I owned 22 stocks over the course of the year, so I had my monkey throw 22 dots on that list of 7,500 companies to see what his portfolios performed like. I let my monkey slave for days and nights until he had done so 100,000 times. Okay, I actually used Excel for this. The results? The median portfolio performed just 8.9%. Nowhere near the 25.3% that the S&P 500 performed. And compared to this number, I'm of course quite pleased with 14.9%. Performing this exercise, I gained some renewed appreciation for how truly volatile this stock market can be. Just consider that even a quite diversified portfolio with 22 companies made a 100% plus gain during 2024 in about 2% of the samples. That's insane. Okay, so I made no mistakes of my own during the year. It was all the US and large cap bias and some volatility. Otherwise I did a perfect job? Well, unfortunately not. I checked one of my own videos actually called Warren Buffett 12 Mistakes Every Investor Makes, and damn, I've committed nearly half of them during 2024. I've been getting attached to my purchasing price. I've been missing the forest for the trees. I've tried jumping over 7-foot bars. I've been too active, or at least I've been checking the stock prices too often, leading to an emotional roller coaster at times. And I've also been a victim of confirmation bias, especially when discussing investment cases with my colleague who runs the Patreon with me. So, I've got some stuff to work on for 2025.
Do or do not. There is no try.
Now, finally, let's check out the US portfolio for 2025. I bought these companies around New Year's, but don't worry, you can actually get them a little bit cheaper than I did, as the portfolio is down a little during the year so far. I invested about 10% of my capital in each of the 10 companies. In alphabetical order. Genuine Parts distributes automotive replacement parts. I used a similar filter that companies had to pass as I did last year. It's quite a tough one, I think.
You shall not pass!
So, Genuine Parts, first, is growing, or at least I don't expect it to lose more than 5% of sales per year. 2, has some insider purchases. 3, isn't too shorted. 4, has reliable earnings. I mean, Look at the reliability of these margins. They max out at 8% and hasn't been lower than 6%, not even during the financial crisis. 5 has a reasonable level of debt, which I define as 5 times EBIT maximum. 6 doesn't have any major issues with regulations. 7 doesn't have any major issues with competition. And 8 is valued lower than its historical average. Right now, you can get Gendrine Parts at an EV/EBIT of 15 or PE 19. Not super cheap, but I wouldn't say that it's too expensive either. Secondly, we have Heidrick & Struggles International, a company operating within hiring and consulting. This one is a little bit more cyclical, but the growth is okay, and the price is better than Gendrine Parts. EV/EBIT 7 approximately right now, thanks to a large net cash position. And of course, as a professional service company, this one has excellent returns on invested capital, something that Warren Buffett, for example, cares a great deal about.
It's extremely difficult to get rich by being the owner of a business that earns a low return on equity. We always look at what a business does in terms of what it earns on capital. We want to be in good businesses.
Keurig Dr. Pepper faces 2 strong competitors in Coca-Cola and PepsiCo, but this company definitely has a good position. Moreover, the industry it operates in is slow-moving. I don't expect any major innovations here. ROIC is incredible, which I'm assuming must stem from them outsourcing the bottling business. Growth is really impressive too, both in sales and margins. EV/EBIT 18-19 is not cheap, however. Leggett & Platt sells bedding products and furniture, primarily in the US, but also in other parts of the world. This company is probably more of a price taker, because it operates in a commoditized industry. However, the industry should also be slow moving, so I don't expect any major changes in competition in the future, and the company has done okay over the last decade or so. It's more of a turnaround, or at least a reversion to the mean from here. Margins have been taking a hit lately. It's currently EV/EBIT 13.5, at the most depressed margins we've seen in 20 years, so that's really nice though.
So you're telling me there's a chance?
LDOS operates within IT services and consulting, almost exclusively in the US. I'm not really sure what happened during 2012 to 2016, but apart from that period, the company looks really stable. The growth is okay, margins are trending in the right direction, the ROIC is extremely high, and the valuation is fine too, at EV/EBIT 12 or PE 14. LKQ is similar to Gendrine Parts in that it distributes automated replacement parts. And just like Gendrine Parts, LKQ has a nice competitive position, thanks to distribution scale and a great sourcing network. The growth is excellent, margins are tight, ROIC is decent, and the price is a little lower than for Gendrine Parts. You shall pass. Manpower Group is one of the largest players within the recruiting industry, together with Randstrand and Adecco. Manpower Group is facing competitive pressure from AI, and the margins are down somewhat from where they've been historically. But, you know...
Just a flesh wound.
In all seriousness, this trades at EV/EBIT 11 at current depressed margins, so I think we can get a serious revaluation if a reversion to the mean can be managed. I have 3% operating margins for what I expect at some point in the future, and that's lower than their 10-year average. Resources Connection is another consulting company, and actually the last one that I allowed in the portfolio, so as to not get too exposed to the fate of the professional services industry. An investor must always try to look at the individual companies as well as the total composition of his or her portfolio. Resource Connection is probably among the weakest players competition-wise in this portfolio, as it has a low market share and a commoditized product. So, why in the world would I want to buy this company, you ask? Well, in the words of Howard Marks, there is no such thing as a good or bad idea, regardless of price. And yes, the price here is low, at least compared to today's frothy valuations for the stock market in general. It's EV/EBIT 11 at today's really low margins of 3%. Assume that they can get back to their 2007 to 2023 average of 6.7%, then it's EV/EBIT 5, or just below that. That is mouth-watering territory. Ryerson Holding is a processor of industrial metals. This is a price taker in a commodity and quite capital-intensive business. But you know what I find attractive about this company?
I could do this all day.
Yep, it's primarily the valuation. The average margins during 2008 to 2024 are 3.5%. Say that they can perform 5 billion in sales. That would mean 175 million in EBIT and EV/EBIT 9 or thereabout. To be quite honest, it's probably the stock that I'm the least interested in among these 10 though, for what that's worth. United Parcel Service, or UPS, holds perhaps the strongest competitive position of all in this portfolio, due to economies of scale and being one of the largest players worldwide in logistics. Both the growth and the margins are very reliable. Margins are down a little, but a ton of analysts think that they'll be able to return to historical averages around 11.5% in 2026. If management is to be believed, they can go even higher. Anyways, the valuation isn't even stretched at these lower levels at around EV/EBIT 15 and PE 17.5. So this might be a case of heads I win, tails I don't lose much. Phew! Alright, it took a little over 6 months, but I managed to produce a new video.
It's done.
As you can see, I can't analyze companies without ticker. And if you'd like to use the same tool, please click here on the screen or use the link in the description. You can sign up for a free account and upgrade if you find it useful. If you'd like to see my private stock market portfolio, head over to the Patreon. Cheers!